Hi, I'm Christian Easterday. I'm the Managing Director and CEO of Hot Chili Limited. We're an advanced copper developer on the coastline of Chile, just making our move into our final phase of development with the release of our recent pre-feasibilities.
Christian, good to see you. So you've got a couple of announcements since we last spoke, and I think I want to deal with first things first, which is the PFS around the Huasco Water and the MOU around the seawater for your own project. So if we start with that, because I think that feeds nicely into, and I think the big question people are asking is, how do you finance the copper project? So without further ado, we're going to dive into that. So why don't you give us the headline numbers around that? Let's start with that. Simple.
Yeah, look, thanks, Matt. It's a very unique piece of news flow that's come out today, some 20 months in the making, to finally put out our first numbers on this strategic asset that we've been developing in Hot Chili to assist with reducing the capital on our copper project and providing a significant amount of funding optionality that would normally not exist in many projects. So, yeah, this morning was exciting to see those numbers. We're really looking at a regional water supply business for the entire Huasco region. Uniquely, we sit in the Atacama, where you're not allowed to take continental water out of the ground. And with 10 years of foresight, we applied for these licenses a long time ago. It took us 10 years to secure. Not many companies, I think 2 in the past 18 years, have secured maritime concessions to take water from the ocean in Chile. So very unique to have that license. More importantly, very unique when it's the only license for an entire region. So this morning we released the pre-feasibility numbers on what a potential large-scale industrial water supply business would look like. Stage 1 is, of course, seawater supply to Costa Fuego by the end of the decade, and being run in parallel with our copper project. And then secondly, and probably more importantly for the numbers, is the development of a potential scalable desalination water business. And so I guess headline numbers for the seawater business, which is where all of this begins. And we've also been able to anchor that business by executing an MOU for the supply of seawater to our own development at Costa Fuego. So effectively providing the backing for stage 1. But that returns some pretty impressive numbers. It's worth about 120 million US NPV, returning a 19% IRR over a 20-year supply period of around 500 litres per second of seawater. But look, seawater is just the beginning. It's what comes next. So we have applications for the upgrade of our existing license. I'm almost 16 months advanced now. And also a second desalination extraction license, still the only license application in the system at the moment. And that looks to usher in what we've now assessed at pre-feasibility level with our independent consultants, Wood and ILF, to be a much larger business opportunity, around 1 billion US post-tax NPV at 8%, returning 19% IRR, and importantly, providing 1,300 litres a second to a much larger opportunity, which is a 4,000 litre per second water catchment opportunity for the entire region. So this is about being an enabler to one of the largest clusters of undeveloped copper projects in the world in one location, probably going to be responsible for the next Escondida scale supply addition over the coming decade. And so this is really important opportunity that we've outlined today for Hot Chili, but a really important opportunity for the community, the agricultural sector in the Huasco region, for government, but most importantly, for very large potential clients being our neighbouring large developers.
Who sets the price for the water? I get metals, I get copper, I get gold. We can see that every day. How do you know what the price is going to be next month, 5 years, 10 years time?
It's been a learning experience for Hot Chili, going through the conceptual phase and then now into completing a pre-feasibility on this. Look, it's not a resource that is priced in global markets. It is very much prices determined locally, depending on the cost of production, and then the expected return or tariff that you put on top of that to ensure the type of investment matrix that the global water sector requires for that investment. So That is the same standard methodology that our engineering and independent engineering groups have undertaken. And so that has given us what the cost to produce it would be, and then what type of return would be required. Chile is one of the probably the most attractive water investment jurisdictions in the world at the moment because of the scarcity of water in the Atacama and the regulatory restrictions on taking water out of the ground. So now what we see is as a range of returns on those investments from our advisors that sits generally in the 12 to 19% return expected on those type of investments. So we've set our return limit at 19% so that we can be conservative, and that's derived $1.38 per pound cash cost for our copper production. Of course, if we were lower at 12 or 15%, we could expect further reductions on our operating cost at Costa Fuego, but we've taken quite a conservative approach. So those are the headline numbers. The capital to build the stage 1 seawater supply pipeline, that's around $150 million US, so returning a post-tax NPV or net profit on that of around $120 million, and stage 2 delivering about $1 billion post-tax NPV against a $1.4 billion US investment, but of course deriving about a 22-year business just on those two alone.
Right. Okay. So I just want to be clear. So it's a regulated environment. You're not saying, oh, cost plus. That you're deciding that's the way that you want to operate.
Yeah,
okay.
This is a private investment environment, and it would be something that Huasco Water would be operating. This doesn't have regulatory oversight outside of taxation and all of the usual things that you have to do to operate a business in Chile.
Okay. So, and just for stage 1, you have secured the kind of maritime concession and easements, etc. For stage 1. Is there anything else for stage 1 that you need to kind of get over the line when it sort of comes to sort of this sort of inline, like the pipeline construction, for instance?
No, the environmental impact assessment also, which we've had 10 years of advance on our copper project, that was associated with this water project. So we've had a huge amount of advance on all of the environmental and permitting work. So the EIA is on track to be submitted in parallel with the copper project so that this is ready to go for the beginning of that seawater supply business. The two will work hand in hand.
Right. Okay. Now, so given this is not going to core business for you, I appreciate the attractiveness of it all, and I guess first mover advantage in that in as well. Who's going to pay for this? Who's going to build this thing?
Well, that's I guess really the unique aspect of this, and I think it's unique for a junior. It's not very unique in Chile. Outsourcing of water infrastructure in most of the mines is going on. It allows the big mining projects in Chile to be built with less capital requirement. So Huasco Water for us is about moving $150 million of capital from our copper project and putting it into that water project. And so outsourcing the capital is one of the advantages of this approach. And secondly, it's then having a industry or industrial partner that is able to finance, build, own, operate, and supply that water to Costa Fuego in this instance. So we've seen these transactions with Antofagasta last year, with Los Andes, one of our peers, and one of Chile's largest industrial consortiums, Colbún, come in to develop that project. And I mean, that was based on a letter of intent. So Hot Chili is extremely well advanced, and that's probably why we're getting a lot of interest from some of the largest global water investors.
Right, and how do you determine what the demand is? Because companies like to come on here and talk to me about addressable markets, but there's no resemblance to what market they can capture. So how do you lay that out for a potential funder?
Yeah, sure. Stage 1's very simple. It's our water demand. So both of the prefeasibility studies have been tied together. 500 litres a second of seawater supply. We've determined the price. We've determined the required minimum return. So therefore, we know our levelized cost of water coming to Costa Fuego, and we know the period 20 years. So that's a minimum set of conditions which we've negotiated our memorandum of understanding with to negotiate our full offtake agreement over the coming year. In regard to stage 2, This is desalinated supply. We've had direct contact with nearly every one of the customers that we've outlined in the pre-feasibility today. NDAs are across those, so we're limited in what we can say. We've also indicated that we already have 165 litres a second of desalinated MOUs, which are the forerunners for offtake agreements that are in place with 2 entities within the Huasco region. And no doubt our 20% owner of Huasco Water, our joint venture partner, CMP Cap, which also require 200 litres per second of water to Los Colorados, about when we're timing the commencement of that desalination. That's quite critical. So we have potential anchors there already on stage 2 towards the 1,300 litres a second, and we have very advanced discussions going on with the other potential off-takers that we've outlined today.
Right, okay, and with all of this, you kind of wrap this up in a pretty bow for someone to come along and do. So demand is one thing. The I guess that all that kind of EIA and the kind of social acceptance, etc. Have you got to manage that as well? I mean, how far do you need to go to say, right, here's something that's going to be attractive to some of these, MOU, some of these groups that may want to build this?
I think the seawater opportunity is obviously not the scale of the opportunity of the desalination. The desalination represents much larger upside than the $1 billion case we put today. We completed a conceptual study on an upgrade of that takes the central multi-user water network up into the Andes, and then potentially can unlock a huge amount of additional scale up on that opportunity. So look, that is very, very big and presents a lot of upside to any potential investor. But stage 1 is about as rock solid as you can get with Hot Chili backing that. So then all of that network really piggybacks off the EIA that is in place and all of the community work that we've done for 10 years. So no, it's a very advanced greenfield opportunity, but it is a regional business opportunity, and that scale is what makes it extremely attractive.
Okay, and so how do you structure this in the best way possible for your copper project? Because potentially there's a annuity stream of cash, or there's a lump sum, or some combination, some hybrid version of this. What's your preference, or is it a case of get what you can?
No, probably not get what we can. I think that it represents a fantastic opportunity to shield our shareholders from dilution on progressing to this build on Costa Fuego and what that will mean. So having a strategic asset like this on top of all of the other things we can talk about is a great opportunity. So we'll want to be careful with what we do, but certainly pre-feasibility on our copper asset at the same time as a pre-feasibility on our water asset has just opened our universe to strategic partnering discussions and sponsorship discussions. So the 80% interest that we have in Huasco Water and we control, we can look at that as a staged buy-in opportunity for potential large water groups, and so it may well be something that is fully, fully executable over the final timeframe towards project financing. Some of the opportunity might be taken early, but the remaining sell down of that project to provide equity funding for the copper project is probably likely to come towards that financing decision on the copper project.
Right. Okay. And so then, how do you decide this kind of strategic decision framework that you're having to put together here? Because there's a lot of moving parts. Clearly, what are the trade-offs for you in terms of how far you go with the desal? And basically, and things like who you work with, how far, because I'm interested in things like, okay, put out a PFS. It's relatively simple engineering exercise. Do you have to spend more time, more money going through, DFS, with that, or feasibility study or advanced economic studies?
Yeah, look, I guess the completing engineering studies on water businesses is a very, very different thing to a mining business. The complexity just simply isn't there, Matt. Neither is the cost, neither are the time frames. So look, we can progress the project forward on the study basis towards a definitive feasibility on that project, and it's not a large cost to the company to add that value. It's also, well within, I guess, our wheelhouse to finalise the negotiations of remaining MOUs, convert those into offtake agreements, and once you have offtake customers, look at the valuation metrics are also grow. So we'll want to continue to develop this business opportunity as rapidly as possible, put more value into those assets. And so, but I guess what we're saying is that we're certainly entertaining a lot of interest at the moment at pre-feasibility level, and you find that once you have pre-feasibility level accuracy on these type of projects, that's generally the commencement point for discussion with potentially, large strategic investors that can develop these assets and finance them.
Okay. I know you're not going to be able to tell me the who, but you can tell me sort of the type of people. So, are we talking industry players, or are we talking pension funds or infrastructure specialists? I mean, what's and will it be a consortium, or do you think there's going to be like one winner? How's it work?
Look, we see that some of these industrial players teaming up. What's been an interesting, I guess, development in Chile is to actually see industrial players from out of the water sector moving into the water sector. So these are very attractive annuity businesses. They have generally very high to 100% debt leverage on them. So it's all about cost of capital. So, the type of entities that build these networks are typically, the large-scale water industry players, the Abengoas, the Almars, the Mitsubishi Waters, Mitsui Waters, Sumitomo's, Morabanes, a lot of very large industrial water players out of Saudi and the Middle East. So, then you have a layer of pension funds and whatnot that are also behind some of these projects and contributing to the financing on those, and then obviously the banking that sits behind that as well. So, we have a range of parties that are interested, from the guys that build them to the guys that finance behind those projects.
So, what's the answer to? Would it be a consortium type approach or not?
It may be a single entity.
Okay.
But we've seen groups team up before, like what happened at Antofagasta. That was a consortium of Transelec with Armar Water, and Transelec is Chile's largest national utility in energy, and first investment into water, which is interesting. And they've teamed up with one of the global majors in water, which is Armar.
Okay, interesting. Right, I kind of want to wrap this side of things up because I'm interested in the copper specifically, in truth. The contribution from this financially, in terms of a sort of anti-dilutory measure for you, the copper project, is significant. So I'm kind of keen to understand what does the time frame look like? You've got lots of MOUs, lots of people looking at data. Does this thing move relatively quickly now?
Look, partnering processes, you never want to rush. We've been having discussions in the lead up to the pre-feasibility with several parties. As I mentioned, we have numerous NDAs executed across our copper asset. We also have numerous NDAs now have been executed across the water project. For all of these parties, pre-feasibility was the commencement point. So, we'll work with those parties, and those discussions, no doubt, will carry on over the coming months ahead. And so that's going on in the background while Hot Chili is organising itself around the bankable study and really starting to plan for the acceleration of drilling on our new discovery at La Verde, which we won't forget to mention. Okay, so there's nothing kind of contingent here that holds things up. No, okay, fine. Well, there we go. Okay, fine. Okay, well, let's dive into the PFS. Obviously, for Costa Fuego. Again, start with the headline numbers, and we'll take it from there. Yeah, look, the pre-feasibility is a huge undertaking, particularly for projects of this size. So we got that out last Thursday on the 27th of March. It was pretty much on time, within guidance. We actually outline a number of key differentials between the PEA, which was done some 20 months earlier in 2024, to the pre-feasibility that was delivered only a few days ago. So look, I guess, headline numbers, we've seen an increase in the net present value after tax. 8% discount was used, conservative long-term 25 bank consensus pricing of $4.30 per pound copper was used. 22.80 on an ounce on gold long-term. And really, really importantly, we were delivering it on over the last week or so has been record copper price day at $5.38. So that $1.2 billion NPV after tax was balanced against a capital on startup that was 1.27 billion. So we're around a 1 on the profitability index, which is really, really encouraging. That delivered a 19% IRR also on the long-term consensus price. But the leverage that this has been able to demonstrate was really significant. So, we did some nice benchmarking in this pre-feasibility, and benchmarking is really important to know your space. So we've just delivered a top quartile production capacity project outside of the hands of a major, and we've just delivered the lowest quartile capital intensity of a developer outside of the majors. So when you deliver on both of those metrics, and then you start looking at the number, it's about context. There are very few of these available, and there are very few that are delivering those metrics within this peer space. So we had, a $1.2 billion profit for a $1.27 billion mine to build. We had operating costs that really performed well, and they did that because we had great improvements on molybdenum recovery, on copper oxide recovery. We had a reduction on our strip ratio from 1.8 to 1.5 on our open pits, and that's kept those cash costs at $1.38 US per pound, which is extremely competitive in this rising price environment. And because we've had an increase in the copper price long term, because we held those operating costs in check, we were able to accept a lot more capital to be deployed into key areas that we were looking to de-risk in this project. We put a lot more capital and a lot more work into the back end underground. That is a component of this project, about 30% of our feed at the back end of the mine life. And we also put a huge amount of extra design work and safety factors and work into really upgrading our tail storage facility. Those were the two real key areas of risk. We also hit a number of other areas of risk, but that impacted our expansion capital. And, we saw about another $470 million go onto our books. But because we've had margin build, rising copper price and a sticky operating cost, we've had margin build in this study, and that has offset against those capital increases and delivered what many are feeding back to me as a very rock solid 20-year, circa 95,000 tonne per annum, 50,000 ounce gold project over that primary production period.
I think it's important to kind of understand some of the economic assumptions, but also the kind of process that you engage with or suggesting with the PFS. I think things like you mentioned kind of strip ratio coming down is great, and I want to talk about things like ore grade and kind of resource confidence, because how have you planned to kind of get after, and we'll come on to the underground block cave bit in a second. What sort of assumptions have you made with regards to kind of average grade over the kind of life of the mine, and where you start and how you kind of, and that kind of grade degradation which will inevitably come, and how you I guess control that in the early years? Where we're starting?
Well, we had a huge amount of de-risking on this project. You would have also noticed that the back-end low-grade sulfide leach, which was around 100 million tonnes in the PEA, has been completely almost removed. I think it's been reduced to somewhere around 25 million, 30 million tonnes, the back end. So that in itself is good to see. The project is extremely conventional. We're not relying on anything that's not conventional here. And we did a lot of work on our transport. We basically, went through this meticulously. We had global experts in their field across 14 areas of risk and opportunity on the project, brought assurance level to the pre-feasibility, and then put an independent technical review on top with the Senko. So we've really gone through this with a fine-tooth comb to produce a really, really robust definition. We've had a lot of I guess, stability in the grade profile over those first 14, 15 years. And then we move into into stockpile reprocessing at the end of the project. But I guess what we have set it up for is the integration of further, higher grade open pit feed into the front end of the schedule. That's the integration of La Verde. We're hitting some very nice results down there. Look like they'll transport, look like they'll give us grade bump, and it looks like it's open pittable. So we are planning now for the integration of a stage 2. You asked about grade, on that 0.45 copper equivalent grade going forward. We did an interesting thing in the pre-feasibility. We looked at the average of the entire undeveloped pipeline of copper projects, and guess what? It looks the same. So, we've got a very, very consistent, high production profile at 0.45 copper equivalent, moving into stockpile processing at the end. And what that does is leave us a lot of room to finish the final stages of consolidation and integration to build that mine plan out towards 30 years. And so this is a serious project in the making, Matt.
Okay, so just remind me. So the kind of first 5 years of the production schedule, that's all based on measured and indicated. Is that right?
Yeah, correct. So
right. Okay.
we don't have any inferred in our blocks. We have a massive investment in the drill out of these deposits. So the bankable stage or the definitive feasibility stage, obviously the first probably around 4.5 years of the mine plan will be drilled out so that we can move probable to proven on our reserves. We announced a maiden reserve of 502 million tonnes, I believe. So about 70% of our indicated resource base was converted into reserve, which is fantastic, of that 800 million tonnes. Obviously, the inferred resource base gives you growth for growing copper prices in the future. But one of the things that we didn't do is we didn't build our mine life and expand all of this reserve by dropping cutoff grade. The cutoff grade stayed the same as the PEA, and so that also helped with our margin build.
Okay, and in terms of the kind of risk to conversion ahead of the DFS, I mean, again, how do you control that? What are you doing about that?
Yeah, I think probably given that nearly all of the tonnes for the payback period and all of the front end of this project is coming from Productora, those areas of starter 1 pit, starter 2 pit, those areas delivered to Hot Chili 200 metre 1% copper intersections from surface. So look, we've got plenty of grade in our front end. We're taking it out bulk and feeding it through. That material obviously gives us front end revenue and torque on our payback. We'd be very welcoming to see more of that material coming in open pit from La Verde, and I'm sure that we've got plenty of room to be able to do that.
Okay, and again, what are the assumed assumptions around the kind of Cortadera component, the underground component?
Look, at the Cortadera really comes into its own in and around year 9 when that open pit feed starts coming off. The development of the block cave is a longer run up. We've significantly increased the development timelines to de-risk that front end risk also. Look, at this stage, it is an open pit underground project. We also completed a conceptual study on big pit versus underground. And look, it was positive. It was a positive scoping study on that assessment. We will probably do more work and start to refine that, because obviously we see the benefit of having all open pit feed here. At this stage, it is a lot more economically robust with that back end underground. But you never count these things out, particularly where copper price is going. Okay,
fine. And just sticking with some assumptions around the economics, because it's just important to me. You assumed a few metallurgical assumptions around these kind of multiple processing streams that you've got, whether it be flotation, heat leach, or the dump, as you say. Can you just give me a sense of what the kind of recoveries are for each of those?
Yeah, look, we're on our sulfide, we're sitting at 86% on the copper. Look, the gold is low because the credit is 0.1, to 0.15, typically on our feed sources at the moment. So, that's something that we've probably got some more work to do, and we might be able to get another 5 to 10% out of through the feasibility work on the metallurgy program. As I said, we've had a great increase on the molybdenum. That's now up around 70%. It was previously around 56%. And we've also had a really good win on our copper oxide recovery, going up towards 70% also. So we've had some nice wins there. I imagine we'll keep going, and the optimization and squeezing every last drop out of this is the work for the definitive feasibility. But no, look, the process streams are very conventional. Look, this is front-end flotation on a sulfide project, producing a concentrate that's 25% target grade, virtually no arsenic, and carrying payable gold, payable molybdenum, which will be stripped out as a separate concentrate product, and also a little bit of silver. But look, it's so small in our revenue balance that it's not worth discussing. On the leaching, very conventional SXEW, very standard heap leaching operation. And then I mentioned the low-grade sulfide leach. Look, I imagine probably by the time we get to the definitive feasibility, that may well even be eliminated. But what we did is we got a common leachate out of the product of low-grade sulfide leaching and copper oxide leaching using Nova Mineralis. So those were producing recoveries on the sulfide up around 39%. But obviously higher recoveries on the copper oxides towards 70%.
Okay, right, and I'm just trying to think about this the sort of recoveries across multiple streams. I mean, so what are the kind of constraints for you, or the kind of the difficulties and assumptions that you've had to make with the ore body and the controls required?
Look, we found actually quite a lot of consistency in our ore sources. Productora is obviously a breccia-hosted ore body. It has higher molybdenum grades in the open pit. And then we've got a porphyry deposit over at Cortadera. Interestingly enough, we had very high-grade molybdenum in the high-grade core, which is the subject of that underground back-end operation. So, San Antonio is such a small source. It's a contributor of around 3 million tonnes to the ore source. So it's not really something that was going to ever concern us. But we saw a lot of consistency. All of the metallurgy was done together. We also just ran, again, all test work to just ensure that we were getting better recoveries using saltwater processing versus desalinated. So that was ticked off. So we went through a series of de-risking exercises through independent assurers brought in outside of our independent engineering group and metallurgy group doing the work. And we reviewed everything. And then we ran additional test work. So you'll notice in the pre-feasibility, we've beefed up more sample analysis. We've also started to look at blending and running those programs. And now we'll be moving into some of those programs, moving to pilot stage. We also had 2.5 year time leaching times on our oxides and on our sulfide programs, from going from mini leaches now to full columns. So quite an extensive amount of work, Matt. I really don't want to go into too much because it'll sound like a book of War and Peace.
No. Fair point. Fair point. Right. I think I guess the perceived issue with this company is your market cap is what it is. Been at it a long time. You've got a big project lined up in front of you, as you say. Not too many of those production profiles around, but you got to finance this thing. We're talking about a big capex. How are you going to do it? What's the financing stack look like, or what could it look like?
Yeah, look, let's call it 1.3 billion US to build Costa Fuego. It is no small undertaking. It's when you comparatively look at the other projects, the crazy thing here is, if it's impossible for Hot Chile to do, it's virtually impossible for anyone to do, because we've got one of the lowest capital intensity projects in the pipeline. So comparing is very, very important. That is an insight into attractiveness in an environment where copper's just hit $5.30, and there's only a couple of these things that are near term and of that scale. So it's about being attractive to financiers, and therefore the optionality on how we're financing this is absolutely key, as it is to every project that has a market cap that is a fraction of the capital required to build something. So this is not new. We are not an island here. This is about the most common point for any company to get to, as there is. So what is really uncommon in our situation is, outside of the fact that we're naturally blessed because we have credit metals in our concentrate that offer things or financing such as streaming that is less dilutive on our shareholders perhaps, and having the ability to put royalties on projects. We've already done that with the Osisko royalty on the existing asset. We kept royalties out of all of the other package, so La Verde is sitting out there on its own with no royalty on it. So, you start to look at the standard mechanisms for how you offset the dilution side. $1.35 billion, 650 million US of equity. That's a huge undertaking. So, when you have 50,000 ounces of gold production average over 14, 15-year period, streaming 10, 15% of your gold can derive a very, very large early sale check. Probably approaching $200 million or more, given where gold price is going. And when you have 40% of your offtake available and uncommitted on those first 8 years, 100% thereafter, we have a great offtake partner in Glencore for benchmark pricing. Benchmark pricing is dropping quite rapidly, so that's encouraging. But when we have this concentrate environment where TCRCs have dropped to zeros, you've got a 4.5 million ton deficit at the moment, and every refiner out there in the world looking to invest in projects that can secure them equity tons and feed to their refineries. That's obviously an avenue that we are very advanced in progressing discussions on. But outside of those typical things, that's where the story stops for nearly every one of my peer that I'm aware of. And that's, I suppose, where Hot Chili becomes unique, in that we have a strategic asset in the water. We've demonstrated a potential $1 billion US post-tax NPV on that by advancing stage 1 seawater supply and adding on a desalination stage to that. And that is our business opportunity that looks to provide a significant chunk of that equity. So my answer is, we'll be using all of the usual levers, but we'll be using a very big lever that we've been gifted in only because of foresight in applying for those licenses over a decade ago. Okay, so this is where the water project kind of potentially comes in and makes this a little bit more palatable for yourselves to take forward. Again, we'll kind of bring that in and kind of merge that in a second. But if I'm looking at the kind of 1.3 billion US dollars here, about a third of that seems to be buffered for inflation and contingencies, etc. So what aspect of the project are you sort of applying that to in terms of, I don't know, whether it be the underground component much later on, or you need to do some prep work or processing plant, or what? Why such a big contingency component? Look, all of the numbers have contingency in them on the capital side, right? So there's about 16% baked in if you want to look at growth factors and contingencies on direct. These things are really important. You don't run sufficient contingencies. We did an analysis of our peer projects over the past 5 years, moving from PEA to prefeasibility. It's in the document. It's fairly telling. So all projects are seeing shifts in operating and capital costs. So setting realistic contingencies is really important in this business, to not disappointing people with numbers and coming in with 50 to 100% blowouts in your numbers. So we would prefer to be, I guess, conservative in our approach there. But coming back to how do you finance this project, my answer in terms of outside of 50% debt assumption, to be conservative again, and not to talk about exchange credit agency opportunities on the debt side, but to be conservative and say, well, let's deal with the 50% leverage equation, to be able to use our precious metal streaming, further royalty options, and our concentrates that are non-committed, and then on top of that, add in a strategic asset that can be outsourced and sold down. That's a very good traditional approach to how you deal with the equity dilution situation for our shareholders. But above all of this, I think that what will Hot Chili look like coming into the end of the year? Will it be Hot Chili, a single asset junior developer talking about a unique opportunity to be able to finance something big? Or will it be Hot Chili sitting with a very capable large-scale partner sitting alongside us to help us fund this last stage and build this project alongside the company?
For sure. But again, before we get there, and we'll come to that, is because I want people to kind of understand what the options are on the table for you, right? So one of the other numbers which might scare people, because until they understand it, is this of the expansion capital. We talk about another 1.3 billion at that point. What point or what market conditions need to be in place before that is triggered, before that decision making happens? Is that a now thing or an imminent thing, or is that someone else's problem further down the line thing?
No, I mean, look, you would have noticed that we also came back $120 million in our sustaining capital. So, a big chunk of the expansion capital was about de-risking the cave. So you bring in a global expert in caving that's built some of the biggest caves in the world, including OT, and you get the right advice. You de-risk it with the capital and the operating and the development timelines and all of the things that turn something into a fairly robust, nice medium-sized cave that sits in the sweet spots for undergrounds. Look, there's risk in open pits, there's risk in caves. We wanted to make sure that was well capitalized, and so that's one of the biggest reasons for that capital increasing on the expansion capital. But just to clear things up, expansion capital is paid for out of the revenues of the mine. So we're not going back to the market for an additional $1.3 billion. That's all being paid for out of the project, and the project's achieving 4.5 years payback with all of that included. So this project generates $17 billion of free cash flow. $17 billion of revenue and $4 billion US of free cash flow over that 20-year period. So you're talking about, nearly $200 million of annual free cash flow generated with all of that expansion capital in. So, the margins are healthy.
Yeah, okay. But it's always that thing about, companies when they kind of get going, mining companies are very good at plowing money straight back in the ground. So I think it's worth reminding that kind of the payback and the free cash flow component is there for sure. In terms of, again, so the focus on where you start and what you start with is going to be important for us to understand, and important for potential strategic partners to understand, because it's difficult out there. Money's expensive out there. With the people that you've been talking to, the groups that you've been talking to, who's in control of that conversation? You're a small company; they've got big balance sheets. How do you punch above your weight when it comes to those conversations?
Well, you do one thing that you get a free kick on, and that's the level of competition that's going on in the market for assets in this class. When there's only 5 of you, I guess you see a deal that happens with Philo and BHP join Jose and Philo together in a joint venture with Lundin. You cross that one off the list, and the list gets smaller. And so this is a pretty tight crowd. Rising copper price and rising competition for these assets gives you that free kick. So you may well be sitting there as the junior with a price that's disconnected from the copper price, like most of our peers are. And we sit there and all of us are wondering, outside of the front runner 4 companies in our space globally, it's been pretty ordinary on valuation disconnect to the copper price. That will change, just as the gold people were probably saying exactly the same thing, with record gold prices and probably only some recent movement outside of the producers. So it's a very similar thing happening in copper. It's no secret that the equity markets are definitely difficult for juniors. So you might feel pretty beaten up, but if you have good cash in the bank, you manage it well, You can get the projects to these levels. You can get the conversations underway, and the groups that can confidently invest in projects of this scale. Then, I guess competitiveness is your friend.
Okay, and just finally, let's kind of finish off on this. It's going to transition from, long-time explorer through getting through the kind of development phases now. I guess the makeup of the management team and the board to allow you to do that, to kind of drive this valuation. You obviously had a few changes recently. Talk to you about the kind of makeup and the shape of the team going forward.
Yeah, look, we as you said, we have had some changes on the board recently, and that was coupled with what we are, I guess, very clear about. The company is transforming into a company that is capable at management, at board and executive level, to take this project into project financing. As you step along each one of these steps, the complexion of your senior group has to upscale, and so we'll be seeing further changes coming to board, executive, and management group that align with where we're going. So that's from very capable executives that have led construction of major copper projects in Chile and around the world, being secured by the company, and we'll see with the next appointments once that's announced, Matt. I won't give anything away too soon.
Okay, well, Christian, I've taken enough of your time today. I'm going to let you go, but there's a lot more to discuss on that. Congrats on both PFSs, and we'll speak to you again soon.
Thanks, Matt. I appreciate it.